Good afternoon. Thank you for joining us today. My name is Steve Wolfenbarger, and I am the Education Manager for AHOA. With the recent tax changes, you may be scratching your head to understand how this will impact you and your business. Today, we are happy to welcome Paul DiNardo, who will help us understand the impact and give you some guidance. Paul specializes in succession planning for business owners, structuring incentive-based executive compensation plans, business merger and acquisitions, corporate partnership, and joint venture taxation. He has also co-authored a real estate tax-specific industry book for Commerce Clearinghouse, The Practical Guide to Cost Segregation. Now, before handing this over to Paul, I'd like to read this disclaimer for all those listening to this presentation. AHOA does not provide legal or business advice or representation to any individual persons or members. AHOA goes to great lengths to ensure the information it provides is accurate and useful, but strongly recommends all persons obtain professional advice and/or legal representation which is appropriate to their particular situation. Further, AHOA does not endorse any companies nor any of the products or services they offer. There will be a Q&A available at the end of the presentation. For any questions you may have, please type them in the question section. Also, we will make today's presentation available for all within 48 hours. We're excited to have you all here today. And with no further delay, I welcome Paul to begin.
Thank you for that introduction, and welcome to a presentation. It could probably easily be a 10 or 12-hour presentation on the tax changes. Before I begin, I'll tell you a quick story, and that is I graduated from college in 1986, and in the fall of 85 and the spring of 86, I'm studying my individual and corporate tax law, and I'm reading from the Internal Revenue Code of 1954. That's how little the code had changed in 32 years. So I graduated in May of 86 and began my job at one of the big four or five, big eight back then, one of the larger CPA firms. And I showed up in the tax department and they hand me the Internal Revenue Code of 1986. The changes were so sweeping in between the time I graduated and the time I started my job that they issued an entirely new set of code and renamed it. And so 32 years later, in 2018, they've done the same thing. So we've been reading from the Internal Revenue Code of 1986. So I suspect it will become the Internal Revenue Code of 2018. So what I'd like to do today is talk a bit about, dive deeper into some issues that are going to affect my hospitality clients. And I think you'll find them germane to what you're doing. But I'm also going to touch base kind of at a higher level on some other things that I think would be good for you to know, but that we necessarily won't dig deep into. There is so much in this new law that I picked three of the biggest items I think are going to impact you, but I'm going to touch on just a couple other ones right now. First of all, the estate tax. They doubled the exemption from roughly $5 million to $11 million. So what that means is we're all allowed to die with $11 million of assets and not pay any death tax. So the big news and what you should take away from this is a lot of people take advantage of gifting. You're allowed to gift assets out of your estate, appreciating assets out of your estate, and all that appreciation avoids the death tax. That limit was $5 million. A lot of people gifted up to $5 million. Well, now the limit's up to $11 million. So you can gift another $5 or $6 million up to $11 million out of your estate and not pay any death tax on it. Now, the reason that's important, it sunsets in 2025, but it may sunset in 2 years or in 3 years if there's a change in control in Congress and they want it to go away. So the one takeaway is look at gifting, and if you gift, you want to make sure that you gift assets that have a very high basis rather than assets with a low basis, because if you were to gift money to a child or a gift value to a child, when he receives that, he's going to have whatever your basis is. So if you give him $11 million worth of Amazon stock, if you paid $1,000 for it, and he sells that stock, he's going to pay tax on that gain. If you give him $11 million of cash, he won't pay any tax when he gets rid of that cash. So when it comes to estate planning, you want to look to gift away property that does not have a lot of appreciation, because when he inherits that Amazon stock, his basis will be fair market value at date of your death, and all that appreciation will escape taxation. So the important thing is that the third bullet point there, the step up in basis is retained at death. So when your beneficiaries receive your inheritance, that their basis in those assets will be fair market value, not what your basis was. All right, so regarding businesses, and I'm going to go quickly here because we have a lot of information to cover. So the tax rates have been lowered to 21%. I mean, you've heard a lot about that. 25% for personal service companies, and so that's really aimed at athletes and doctors and lawyers and accountants, people who trade or make money based on the reputation of personal services. The IRS says, look, what people used to do is they would stick that income in a C Corp and take advantage of the lower rates. And the IRS said, look, if you're a company and all you do is provide personal services like a lawyer or like a doctor, then we're going to tax you at the highest corporate rate on the first dollar. You got the people on this call, the participants in this call, would definitely not fall into that. If you're in the hospitality business, if you sell widgets, if you sell hours to hotel rooms, that does not qualify for PSE. So you can avail yourselves of the 21% lower tax rate if you want to be a corporation. There's also a lower tax liability for certain pass-through business income. The Congress wanted it to still be competitive to be a pass-through business, and so they dropped the corporate rate from 35 to 21%. They likewise dropped the individual rate from 39.6 to 37, but they also allow a 20% reduction in that tax rate if you had qualified business income, and we'll go into some examples of that in a little bit. There's also an increase in expensing of capital items, very generous write-offs now. Business interest expense can be deducted. We'll talk a little bit about that. If you lose a lot of money in your business, you may be limited as to how much you can take, and then you can carry forward the excess. We're not going to get into that, just make you aware of that. Net operating loss deduction has been modified a little bit. I'm going to touch briefly on like-kind exchanges. There have been some changes on doing what's called a 1031 swap. So at the end, I'll try to leave some time for some Q&A. All right, so this is kind of an interesting graph. It shows the rates in 2017, 2018 for individual rates. You can see that the top rate is now 37%. Last year it was 39.6, and the 37 doesn't kick in until $600,000 of taxable income. So if you want to kind of know where you are in the rate grand scheme of things, just take a look at these rates in this table. All right, so business pass-through income. So there's a special tax rate on what's called qualified business income. You may hear the term QBI, and this is what really is going to benefit the individuals in hospitality businesses. The deduction is up to 20% of your QBI from a pass-through entity. So when you receive a K-1, if you operate as and this is only for individuals, this is not for corporations, this is for C corporations. So if you operate as an S Corp or an LLC and you receive a K-1 and you have ordinary income on line one, that's typically going to be your QBI. And what that allows for, it allows for an effective tax rate on that income of 29.6%. And the way we get there is we say, okay, the top rate right now is 37%. But if you have QBI, if you're a business owner and you're generating business income, we're going to allow a 20% rate reduction on that 37%. So if we multiply 37% by 80%, which reflects a 20% reduction, we're at 29.6% effective federal rate on QBI. Now, it does not include salary. So if you receive a K-1 on an S Corp, you have income on line one, that's QBI. If you are an LLC member, you probably have income on line one as well as income on the guaranteed payment line. That guaranteed payment line is not considered QBI, that's considered compensation. So the lower tax rate only applies to the business income from the entity. So if you go to the very bottom of the screen, the limitations, the 20%, there are other hoops you have to jump through. The 20% of QBI is the maximum amount you can get, and then there are other deductions you have to go through. However, if your taxable income is under $315,000, you don't have to jump through any hoops. You get the 20% rate. If your taxable income is above $415,000, you have to jump through all the hoops, and if it's between $315,000 and $415,000, it phases out, and it gets a little bit more complicated there. You can actually have an effective tax rate of about 100% as you lose the benefit of this 20%. But the taxable income, if you're above $415,000, the deduction is limited to 50% of W-2 wages. So the IRS wanted to make sure that people are being employed, and what they said was, all right, when you multiply the QBI by 20%, let's suppose you have $500,000 of QBI, 20% of that is $100,000. So the IRS says you could take up to a $100,000 deduction, but you're limited to the wages of the business, 50% of the wages of the business. So if I own an S Corp, and I'll go through some examples in a minute, $500,000 of QBI, and let's say I have $300,000 of wages. 50% of my wages is more than my 20% of QBI, so I get the full 20%. So then the real estate owner stood up and said, wait a minute, we own buildings that we don't pay wages for, and so we're getting shafted. And they said, yeah, you're right. So at the last minute, they added this provision. The limit is going to be either going to be a greater of 50% of wages or 25% of wages plus 2.5% of unadjusted basis of fixed assets. That's going to be depreciable assets, not land. So if you have a building, you don't pay any wages, you still get a 20% reduction on your QBI, limited to 25% of your W-2 wages plus 2.5% of the unadjusted basis of the assets. And I'll go through an example in a bit. So the deduction cannot exceed the lesser of combined QBI amount or 20% of taxable income. So the last limitation is it can't be greater than taxable income excluding capital gain, and that'll be included in my example. So here's a little matrix for you. So first of all, personal service corporations are a little bit different, but I'm not going to get into detail on those. If you're a PSC and you're under 315, you get the 20%. If you're above 415, you don't get the 20%. But for the people on this call, business owners who have QBI, have business income, question is your taxable income, is the individual taxable income under $315,000 joint or 157.5 individual? If the answer is no, my income is not over that, the calculation is easy. QBI times 20%. My taxable income is between the 315 and 415 before the phase out. The deductions may be phased out. And if you're over 415, you have to go through the calculation we just talked about. QBI times 20% plus the greater of 50% of the wages or 25% of the wages plus 2.5% of the unadjusted basis. This is important. This test is done on a business by business basis. So each business you have has to be tested on this. So if you have a situation where you may have one business where you're not able to take full advantage of the 20% because your wages are a little bit lower, but you have another entity that has significant wages, there may be some opportunity to shift wages from one entity to another in order to take advantage of this deduction. So it does require a little bit of planning. I would encourage you not to try to do it on your own. If you handle your own tax planning, I can assure you, you will have a fool for a client. So what I wanted to do is, the question I'm getting most right now is, corporate tax rate's 21%. Holy cow, should I be a corporation? Right now I'm an LLC, right now I'm an S Corp. 21% tax rate sounds very attractive. So I'm going to due to the limitation of time, I'm going to save you going through the details of this, but the long and the short of this is, if I have taxable income under $315,000, very low taxable income, on the left there, I got a pass-through rate of $100. I get the QBI deduction of $20. I have an effective tax rate of tax rate's 24% on the $80. Essentially, I'm paying $19 on $100 of income. So my effective tax rate is 19.2%. If I'm a C Corp, I have a nice 21% tax rate, which I pay $21 on, but I also have to pay a dividend rate in order to get that cash out. So my effective tax rate is 35.85%. So even though the corporate tax rate went from 35 to 21, the individual effectively went from 39.6 down to potentially 29.6. So what happens if my taxable income is a lot higher than $315,000? Suppose it's $600,000 and I'm in a higher individual tax bracket, but the corporate rate at 21%, it just stays flat at 21%. So even though I'm making a bunch more money, the corporation tax rate remains static. So if we go through the calculations, my tax rate goes up to 29.6% if I'm an S Corp or an LLC. If I'm a C Corp, it goes up to 39.8%. And the principal reason on this is that in order for you to get the money out of a C Corp, is you have to take it out as dividends, and if you take it out as dividends, you're paying a second level of tax. There are some other problems with C Corps as well. So typically, our firm, we do work with thousands and thousands of clients. I can probably list on one piece of 8.5 by 11 sheet of paper list of all of our C Corp clients. There are some very specific reasons to be a C Corp. that kind of go beyond the scope of this, but our recommendation is right now we still maintain a pass-through status S Corp or LLC. If I had to create a scenario where it may make sense to be a C Corp, I haven't actually run the numbers. It may be that if you have a leverage buyout, if you borrow a ton of money to buy a company and that liability is sitting in the entity, if you were a C Corp and you were going to retain all your profits to pay down that debt and not take any money out yourself, then there might be a benefit to being a C Corp. And then later on, you could elect S status. But if we're just talking about a traditional operating business looking to take cash out, you should not think about switching to a C Corp status. So let's go through the calculation of the W-2 limitation. So in this example, we have taxable income of $600,000. It's a married or larger married filing joint tax return. So our qualified business income receives a K-1 showing $700,000, and we have the potential to take $140,000 deduction, 20% of our QBI. And service comes in and says, okay, well, you may be able to take that, but let's compare it to your W-2 wages. And so the entity, so if I own half the entity, right, the entity makes $1.4 million, I get a K-1 for 50% of that of $700,000. Those W-2 wages represent my share of the total W-2 wages. So the entity would have $400,000 of wages. I would get half those wages. And then they say, okay, well, the 20% is going to be limited to 50% of your wages. Your wages allocable to you as the owner are $200,000. Half of that is $100,000. So I get to take as a deduction the lesser of the 20% of 700 or the half the wages. So on the right side, you'll see I have QBI of 700. I have the 199A, which is the Internal Revenue Code section that it references. I get a $100,000 tax deduction. Taxable income from the business is now 600. I apply a 37% tax rate to that 600, but you got to remember I'm excluding the $100,000 of that income just escapes taxation. So it puts my effective rate down to 31.71%. All right, so now we've got a real estate investment. We got somebody who's got a bunch of income, tax rate at $600,000. Qualified business income of $70,000. They get a K-1 that's showing 70 grand. They have the potential to take a deduction of 20% of that, or $14,000. The W-2 wages in this real estate partnership happen to be zero. It's just basically a piece of property. It's got a nice triple net lease, and it's making a little bit of money. And so the first threshold would be, well, our $14,000 is limited to half our W-2 wages, which is zero. And so we go to the next step. Well, we can take 25% of wages, which is still zero, plus we can take 2.5% of the unadjusted basis of our assets. So in this situation, we have unadjusted assets worth about $2.3 million. So our threshold is $57,500. So we get the lesser of the 20%, which is $14,000, or 2.5% of the unadjusted basis of the assets. So on the right side, you'll see that we get qualified business income, taxable income of $56,000, which gives us an effective tax rate there of 29.6%. And so in this situation, to the extent you can increase QBI by deleveraging, you may be able to generate a larger tax deduction. If you have less interest expense driving that QBI number down, you'll get a bigger Section 199A deduction. So deleveraging may make sense in this case. All right, so here we have an example of a sole proprietor. He operates this. Tammy is married with $100,000 in net business income from her donut shop. She and her husband have $34,000 of other income, and will take a standard deduction of $24,000. So the calculation would be QBI, net business income, is $100,000. This is their tax return right here. Okay, this is what's actually on their tax return. Income of 100, income of 34. So total adjusted gross income is 134. They're taking a standard deduction, which now has been increased to $24,000. Their taxable income is $110,000. So the QBI deduction is the lesser of 20% of the 100,000, which is 20,000, or 20% of taxable income. So there are a couple of different limitations you got to jump through. And so in this case, your taxable income is 110, so 20% of that's 22,000. We pick the lesser of 20% of QBI or 20% of taxable income. So in this case, the QBI deduction is equal to $20,000. All right. Here is another example of a sole proprietor with $1 million of net business income from his hotel business in 2018. He and his wife have $50,000 of other income and $60,000 of itemized deductions. So the calculation for them would be The hotel business has $250,000 of W-2 wages and $100,000 of assets. So in this case, he's either leasing the building from somebody else or he has the building in a separate entity that has $100,000 of assets. So you can see how we get the taxable income, gross income of $1,050,000 minus itemized deductions. So taxable income is $990,000. So the first thing we do is we say, okay, we have QBI of $1 million, so we have the potential to take a $200,000 deduction. Or we have to compare that to 50% of wages, and 50% of wages is $125,000, or 25% of wages plus 2.5% of the unadjusted cost basis of the assets. So that comes out to be $65,000. So in this case, they're much better off with the 50% of the W-2 wages, even though it's less than 20% of the QBI. So just remember, there are a couple of limitations. One is the 20% on investment or business income, and there's also going to be a limitation based on taxable income. All right. So this is an example of a 25% partner in a partnership called Green Space. It's a rental real estate partnership, $250,000 of pass-through income, $30,000 of other income, a standard deduction of $24,000. So here we've got the 20% of the QBI is $50,000, and 20% of taxable income is $51,200. So we can take the full $20,000. I think this is my last example for you. A partner in a partnership. Actually, yeah. So partner in a partnership, Peter's married with and is a 50% partner in Bounty LLC, a rental real estate partner. Partnership has $750,000 of pass-through net business income in 2018. Peter and his wife have $100,000 of other income, and we'll have $50,000 of itemized deductions. The reason the $10,000 in real estate taxes and income taxes keep coming up because the limit next year is $10,000 for real estate, and your tax deduction on your individual return is limited to $10,000. So Bounty has $120,000 of wages and $4 million of assets. So the calculation, this kind of has all the pieces in it. The calculation of the taxable income is $800,000. So the QBI deduction is the lesser of 20% of net business income, which is $150,000, or 20% of taxable income, which is $160,000, or 50% of wages, or 25% of wages plus 2.5%. I know I'm kind of going through each one of these calculations is a little bit different, so I wanted to give you a series of examples to look at. But in the end, basically, 25% of wages is $15,000, and the 2.5% of the unadjusted basis is $65,000. So we're limited to the lesser of those two numbers. So the deduction there is $65,000. So bonus depreciation, they've expanded bonus depreciation to include used property. Bonus is a full write-off of assets that you're acquiring. Bonus depreciation used to only be on brand new assets. It's now on assets that are new to you, whether you buy them new or used. And we'll be able to write off 100% of those assets through 2022. And then in 23 through 26, it gets phased out. This phase out was put in there to make sure that this bill balanced from a revenue and cost standpoint to stay under the threshold that allowed it to stay in conference. All right, so cost recovery for Section 179, you may have heard that terminology used from time to time. Section 179 is a part of the Internal Revenue Code that also allows direct expensing of property. When bonus depreciation was limited to 50%, we would take all of our Section 179 first because we could write off all of the 179, and then we go over to bonus. But now bonus is 100%. Section 179 has been increased from $500,000 to $1 million. And that you can take the $1 million so long as you're not considered a large taxpayer, and a large taxpayer is defined by how much in assets you put in service in any 1 year. So the ability to take a 179 deduction phases out when you place in service more than $2.5 million. And the 179 applies to new and used property as well. All right, so 179 expands the definition of qualified tangible personal property and qualified real property eligible to include, and this will be of interest to people here, a tangible personal property used predominantly to furnish lodging or in connection with furnishing lodging, improvements to non-residential real property placed in service after the date such property was first placed in service. This is an important point. And I would highlight this part on the slide. If you make improvements to a non-residential real property, anytime after the property is placed in service, you can write those improvements off. So if you build a hotel, or you build a building, or the day you get a CO, certificate of occupancy, the building is considered placed in service. Any improvements you make with regard to the roofs, heating, ventilation, and air conditioning, fire protection, alarm systems, security systems, all that you can write off. There used to be a 3-year window, but all that's gone now. And so the regs are very specific, the rules are very specific to say it's after the date the property was placed in service, which to me means then I wouldn't do it the same day and say, hey, I put the property in service at 10 a.m. and now it's 3 p.m. and I'm going to do it. I wait at least a day to be safe. All right. Qualified leasehold improvements. You may have heard this term in the past. Qualified leasehold improvements, qualified restaurant property, qualified retail improvement property. It now just falls under one term called qualified improvement property, and most of those items are eligible for Section 179 expense as well. So the last thing I want to talk about is the business interest deduction. And so this is for businesses over $25 million. So if you don't have more than $25 million, you don't have to worry about this. But if you see the first line on that bullet, businesses with the average gross receipts that do not exceed $25 million are exempt. However, it's tested on an affiliated basis. So you can't set up, you can't set up multiple entities to get around the 25 million test. So when they say 25 million, if they look at all your aggregated activities, and we're waiting for rules to be written, there are going to be a lot of rules written, and there also needs to be some technical corrections because there was some stuff that they intended that they've actually got wrong with their wording. But one of the things they've said is that the $25 million is going to be tested on an affiliated basis, but we haven't gotten clear guidance yet on what exactly they mean by affiliated basis. Does that have to be identical ownership? Do you have to have more than 50%, or what? So the proposal would disallow interest expense in excess of 30% of a business's adjusted taxable income. So adjusted taxable income is computed without regard to deductions allowable for depreciation, amortization, or depletion. So think of it this way. We've got a rental real estate property, and I look at my cash flow. What's my cash flow for the year? Excluding the principal payment. So if you think about what shows up on your income statement, everything on there that's income or expense you get to take, except for you ignore depreciation, you ignore depletion, you ignore amortization. Whatever that number is, you multiply by 30%, and that's how much interest you can take. If there's excess interest, that can be disallowed, but it's carried forward indefinitely. Okay, and this is determined at the tax filer level. The partnership is going to be subject to the testing, not the partners. So the partnerships will run this test and say, okay, if this entity is north of 25 million, then we're going to have to limit the interest expense. The real challenge is going to be, how is the service going to know if you're in 3 partnerships that have $15 million in revenue? How are they going to know that, because you could have somebody who's managing one of those properties that is not aware of the other 2 properties that you own. So it's going to be a challenge for the IRS to manage this process. So if you have three, let me go to the example here. I know we're running short on time. The last bullet point on this is important to note that you can elect out of some of the beneficial depreciation deductions and get around this rule. So you can say, okay, look, I'm not going to take bonus. I won't take a lot of these beneficial deductions that I'm now allowed to take, but I won't be limited on my interest expense. That's something you're going to have to look at. Here's an example of the interest expense limitation. Jerry and Mary own a number of nursing homes. All the facilities are owned by corporations started by Jerry's great-grandfather. That means that we have a very low basis. Average gross receipts are 40 million. Adjusted taxable income is about 5 million. So the business has an enormous capital requirement and pays over $2 million a year of interest annually. So the limitation is 30% of adjusted taxable income, or $1.5 million. So of the $2 million of interest expense, they can only deduct 1.5 million. So if you think about this in the context of real estate partnerships, if these are the same numbers, but it's a real estate partnership, and I have 10 partnerships I'm involved with, 5 of them are above the 30% limitation, and 5 of them are below the 30% limitation, you might want to take a look at how to re-leverage your assets to make sure that each partnership is closer to that limitation. So it's now more important to make sure that the leverage makes sense on a property-by-property basis rather than just in the aggregate. So that's your takeaway on the business interest expense. Last note here is on like-kind exchanges, and I'll be really quick on this. Before you could swap, a like-kind exchange is trading one kind of property for a similar type of property and not paying any gain. The IRS was going after real art dealers. They didn't like them trading Renoirs for Cezannes and getting more valuable artwork and not having them pay tax. So they disallowed the ability to do a like-kind exchange on personal property. What this does, it makes cost segregation studies more important. And that's where we really focus a significant portion of our practice. We literally wrote the book on cost segregation studies. If you're swapping a building, you're going to pay tax. You're going to have gain on all the depreciated personal property that you've taken. But under the new rules, if you identify the new property properly, you can then write off the acquisition of all the personal property that you're acquiring. So it should be a wash. A 1031, you used to have to swap equal or up in value and equal or up in equity. And as long as you do the same thing and you have a cost segregation study done, you'll be able to avoid any gain on swapping personal property, which I think was the intent of the rules. Like, the government didn't want to see business owners get hurt with this. And so that's one of the reasons they have these very generous depreciation rules. All right, I got 15 seconds left on my 30 minutes. I'm really sorry. I had a lot to talk about. I'll turn it back over.
No problem, Paul. If you go to the last slide, yep, there you go, so everyone can see your contact information. We do have some questions, and I apologize. If I have an LP with an S Corp general partner that owns 50% of the LP, and the LP has W-2 wages, looks like $400,000, does the S Corp get $200K of W-2 wages applied to it?
They get credit for the two. So you look at the entity level. If the LP has $200,000 of wages, the QBI coming out of the LP into the S Corp is going to carry with it the wage test. So those $200,000 of wages will flow up to the S Corp out to the individual for testing purposes.
Oh, perfect. Okay. And if there's any other questions, please type them in. Does capital gains from asset sale of pass-through business qualify for 20% deduction as QBI or only line 1?
Capital gain on the sale of business assets is not considered QBI. Capital gain is excluded from QBI, but that's okay because the capital gain rate is lower than the reduced individual rate after taking into account the QBI deduction. So if it's true capital gain, so you have several different types of gain when you sell a business. If you have goodwill, it's going to be a regular capital gain. If you're selling assets, you might have some ordinary income recapture. If you have true capital gain income, then that's going to be taxed at the lower tax rate of 20%. If it's a C Corp, it may be a little bit higher because of the additional Medicare tax, but it's not eligible for the QBI deduction because it's already taxed at a lower tax rate.
Okay. And Paul, does the changes, are they in effect as for 2017, business, or is it for 2018 and forward?
Yes, that's a great question. And the answer is yes. The depreciation deductions are in effect for assets placed in service after September 27, 2017. Everything else goes into effect in 2018. There's also one other subtle change that they made that's important for everybody to know, and that is the cost of parking. We have about 85 people that work for us. We pay for their parking. The IRS now says that's a personal expense. And so we are either going to have to treat that as a non-deductible expense to our company, or we're going to have to include it in our employees' compensation. All my hospitality clients, or most of them, have parking lots outside their building that they don't charge anybody for, but there's a chance the IRS may say, look, there's a value to that parking and you're going to have a non-deductible expense. So we're waiting for rules on that as well. So there's a lot of stuff in here. I just wanted to get to the things that I thought would be most important and have the biggest impact.
You mentioned throughout the presentation that they're going to have to work on a couple of things. What are you seeing as being the biggest item that's going to be changed?
It's more of a technical issue. Their intent was to allow us to take bonus depreciation in 179 on a certain class of assets. And in order for that to happen, the assets have to have a life of 15 years, but they're still defined as assets with a life of 39 years. So we're going to expect that to come through. That definitely needs to be changed. So some of it's a little bit more subtle that kind of is inside baseball for us CPAs. But what we're mainly looking for is a lot of guidance on how to interpret these rules. What does it mean to be an affiliate? How do I aggregate my companies? And so that's going to be the real challenge.
Okay, perfect. Well, we want to thank you, Paul, for this very informative webinar. I know I learned a lot on it, and I hope everyone else that is here did also. Feel free to check out our events calendar on the AHOA website for other webinars we have coming up, and also in our resource library for past webinars we have done. Have a wonderful day, everyone, and I hope to see you join us for future webinars and AHOA events. Thank you.